Infrastructure spending has become a hot topic in recent years, with governments around the world allocating significant resources to fund new projects. While the primary goal of infrastructure investment is to improve public services and stimulate economic growth, it can also have unexpected effects on the stock market. As a result, investors often look to infrastructure spending as a potential indicator of stock market performance. So, in this video, let us dive deep into how decisions related to infrastructure spending can affect your investments in the stock market. Government infrastructure spending can be classified as monetary funds used by a government towards the development and maintenance of public facilities and services, such as roads, bridges, schools, hospitals, and public transportation systems. Infrastructure spending serves several primary objectives that are worth noting. One of the main objectives of infrastructure expenditures is to improve public safety. This can be achieved by building and maintaining roads, bridges, and other structures to ensure they are safe and reliable for public use. Additionally, infrastructure investments can enhance emergency response capabilities, such as through the construction of fire stations and hospitals. Another objective of infrastructure expenditures is to increase efficiency. This can be achieved by investing in transportation systems, such as railways and airports, to reduce travel times and improve the movement of goods and services. Upgrading communication networks and power grids can also increase efficiency by providing faster and more reliable services to businesses and households. Lastly, infrastructure expenditures should aim to promote sustainability. This can be achieved by investing in renewable energy sources, such as solar and wind power, and implementing green infrastructure, such as green roofs and rain gardens, to mitigate the effects of climate change. Investing in sustainable infrastructure not only benefits the environment, but can also lead to cost savings in the long run. Overall, infrastructure expenditures should prioritize public safety, efficiency, and sustainability to support economic growth and development. Economic growth helps foster a higher quality of life, along with fast-paced innovation that promotes the creation of job opportunities, which in turn impacts the companies in the stock market. Now let's take a look at the impact that government infrastructure spending can have on the stock market. Infrastructure spending can have a significant impact on the stock market. When a government announces plans to invest in infrastructure projects such as building roads, bridges, and airports, it can lead to an increase in stock prices for companies in the construction industry. This is because these companies are likely to receive contracts for the projects, which can lead to increased revenue and profits. Additionally, infrastructure spending can have a positive impact on companies in related industries such as engineering and materials. These companies may also see a boost in stock prices as a result of increased demand for their services and products. However, it's important to note that the impact of infrastructure spending on the stock market can be short-lived. Once the projects are completed, the initial boost in stock prices may fade away if companies are not able to maintain the same level of revenue and profits. While infrastructure spending may have positive effects on the economy as a whole, it can also have negative impacts on the stock market. One of the main downsides of infrastructure spending is that it can lead to rising inflation. As the government spends more money on infrastructure projects, it increases demand for goods and services, which can drive up prices. This can lead to higher inflation rates, which can be detrimental to the stock market. Another potential downside of infrastructure spending is that it can lead to higher interest rates. As the government borrows money to fund these projects, it can drive up interest rates, which can make it more expensive for companies to borrow money. This can lead to reduced investment in the stock market, which can cause prices to fall. Additionally, infrastructure spending can be a double-edged sword for certain industries. While some sectors may benefit from increased government spending, others may be negatively impacted. For example, if the government invests heavily in renewable energy infrastructure, it could hurt traditional energy companies such as oil and natural gas, leading to lower stock prices in that sector. What can you do as an investor to tackle changes in government spending on infrastructure? When governments increase their spending on infrastructure projects, it can create growth opportunities for companies that provide materials and services for these projects. This can lead to increased profits for these companies and, in turn, can positively impact their stock prices. Additionally, infrastructure spending can stimulate economic growth, leading to increased consumer spending and overall market expansion. This can also have a positive effect on the stock market as a whole. However, it's important to note that not all companies will benefit equally from infrastructure spending. It's essential to consider which companies are best positioned to capitalize on these opportunities and which may face challenges. If the government spends too much money, it can lead to inflation, which can have a negative impact on the stock market. Inflation can lead to higher interest rates, which can make it more expensive for companies to borrow money, and can also lead to reduced consumer spending, which can hurt company profits. Furthermore, government spending can also impact investor sentiment and confidence. If investors believe that the government is spending money wisely, this can lead to increased confidence in the economy and the stock market. On the other hand, if investors perceive the government as wasteful or inefficient in its spending, it can lead to decreased confidence and a decline in the stock market. Infrastructure spending can benefit certain industries, like construction and engineering companies, that are involved in these projects. As these companies earn more revenue from infrastructure projects, their stock prices can also rise. The impact of infrastructure spending on the stock market can vary depending on the specifics of the projects and the overall state of the economy. It's important to consider factors like interest rates, inflation, and global innovation trends when evaluating the potential effects of infrastructure spending on the stock market. While there is no guarantee that infrastructure spending will always result in positive stock market performance, it can certainly play a role in driving economic growth and boosting investor confidence. As an investor, it is vital to pay attention to primary indicators of economic health at any given time before investing large capital into the stock market. That is it for this video. If you found this video informative and engaging, please show your support by liking and sharing it with others on social media. Hopefully others can learn something new or refreshing from this video that they can use to help navigate the wild waters of the stock market. Comment below if you would like to see more explanations like this or suggest other ideas. I will do my best with my time to cater to your requests. Please do subscribe and turn on all notifications to get updates on new videos on the channel about the stock market, deep dives on economic principles and the world of finance. Take care and have fun in your investment journey.